In today's lesson, we are going to be looking at one very important topic in financial accounting. It is diminishing or reducing balance method of depreciation. First of all, I want to establish the fact that if you have not gone through the previous videos on depreciation, you go back to those videos and get yourself used to those lessons so you'll be able to appreciate this topic. This is one of the various methods one can use to calculate depreciation. It is called diminishing or reducing balance method. We have other methods like straight line method, some of the A-digit method, revaluation method, and so on and so forth. But today, we want to focus our attention on reducing or diminishing balance method. Now, before we make progress, let's look at the lesson objectives, those things that will guide our journey in this lesson for today. The first thing is that we'll be able to define diminishing or reducing balance method of depreciation. We'll be able to state the formula, we'll be able to solve related questions, and we will see how we'll be able to post provision for depreciation to the necessary account. And then at the end of the lesson, we are supposed to measure our level of success. We call it success criteria. And then what we determine if we've been able to achieve our objective. And number one, if we've been able to define the diminishing or reducing balance method of depreciation, if we've been able to state the formula, we've been able to solve related problems, and if we've been able to post provision for depreciations to the necessary account. Now, let's look at the definition of diminishing or reducing balance method. Normally we call it definition because there is need for us to explain what this topic, what this method is all about. But we can simply call it description. We want to describe in what way can you differentiate this method from other methods. Like I mentioned earlier, we have straight line method, we have some of the A-digit method, we have revaluation method, we have disposal of asset method, we have depletion method, and we also have amortization method. Different methods can be adopted to determine the depreciation of a fixed asset. But this method is also a function of the policy of a company. A company can decide to adopt either of this method. So what I'm trying to say is, in today's lesson, we want to see how we can be able to demystify this method in such a way that if students stumble on this method, they can differentiate this method from other methods. Now, when we talk about diminishing or reducing balance method, we are talking about a method by which a fixed percentage is written off the diminishing balance of the asset yearly. The total depreciation is spread over the anticipated useful life of the asset by annual installment or diminishing amount. Now, what I'm trying to say is that when I say a fixed percentage is written off the diminishing balance of the asset yearly, is that it is assumed that no assets can be effective throughout the period of the business. When you acquire or when you procure a particular asset, that asset have what we call lifespan. There is a period where that asset cannot be effective again. So what is expected in accounting or as an accountant is that you must apportion or you must divide the value of that asset over the period of the life of the asset. If you don't do that, at the end of the asset, you will not be able to get or you will not be able to have enough money to replace the asset. So the process that is involved in dividing the value of that asset over the lifespan of the asset is what we call the depreciation. But in this context, we are trying to look at how a percentage of that value can be used as the asset is used in the operation of a business year in, year out. Year one, a percentage will be taken out. Year 2, a percentage will be taken out. Year 3, a percentage will be taken until the lifespan of the asset is exhausted. So I said that the total depreciation is spread over the anticipated useful life of the asset by annual installment of diminishing amount. What I mean by annual installment is that this installment must come annually. It will come once in a year, and it will look like it will come in the form of a diminishing amount. What I mean by diminishing amount is that there will be a drop in the amount of depreciation that will be charged. If initially you charge 5,000 naira as depreciation, the subsequent year may not be 5,000 again. It will drop maybe by 2,000 or by 3,000, because under the diminishing balance method, the amount that will be charged at the beginning of the asset is always higher than the amount that will be charged at the end of the asset. So I said, hence, I say a large amount of depreciation is deemed to occur in the early years and smaller amount in the later years of the asset. What are we saying here? We are saying that when you just got an asset, at that initial stage, the asset have everything it takes to generate the expected economic value. You know, the asset is still very strong. It's still very, very, new to deliver. But as time goes on, you see that, as you are using the asset begin to wear out. The asset begin to reduce in value. So the wisdom is, at that stage when the asset is still very strong, there is need for you to charge a larger amount of depreciation. And then when the asset is now approaching the period we call the menopause, the period where the asset will not be able to deliver again, the depreciation at that time must have dropped drastically. So we say larger amount of depreciation is deemed to occur in the early years and then smaller amount in the later years of the asset. I have said earlier that we want to see how we can present this method in such a way that students can differentiate this method from other methods. So you ask me, in what way is this method different from straight line method? Number one, in straight line method, the depreciation that is charged is uniformed. Now, what you charge in year 1 is what you charge in year 2. What you charge in year 2 is what you charge in year 3, all through the life of the asset. That's for straight line method. But for reducing balance method, what you charge in year 2 is different from what you charge in year 3. What you charge in year 1 is different from what you charge in year 2, and so on and so forth. That's the number one. The second difference is that in reducing balance method, a larger amount of depreciation is charged at the beginning of the asset, and then a lesser amount is charged at the end of the asset. Meanwhile, on straight line method, at the beginning of the asset, the depreciation that is charged at the beginning of the asset is the same thing with the depreciation that is charged at the end of the asset. That is why they call it straight line method. I think with those two examples, you'll be able to differentiate straight line method from reducing balance method. Let's quickly look at the formula. The formula for calculating the depreciation rates using the reducing balance method is very simple. The formula is simply 1 minus the end root of the residual value all over what? Cost. This is how to find the percentage. Now, sometimes they can give you the cost of an asset. They can give you the residual value. Remember, we have said that residual value, you can either call it residual, or you call it scrap value, or you call it residual, you call it scrap value, or you can call it residual value, scrap value. You can also call it disposable value. Disposable value. So you can either call it residual value, you call it scrap value, you call it disposable value, or you can call it the expected value. Now, all these terminologies are just, they are used to describe the asset at the end of the asset life. So you can see an illustration where you'll be given the cost of the asset. You'll be given the expected value or the residual value, the scrap value or disposable value of the asset, and then you will be asked to determine the depreciation rate. Now, at that point, they didn't give you the percentage you are going to use to charge the depreciation. What the formula you will use to determine the depreciation is what I have written on the board now. It is 1 minus the n root of residual value all over the cost, where n is equal to the number of years. N is equal to what? The number of years, or what we call the useful life, number of years of the asset. Then residual value is simply the value of the asset at the end of its useful life. Why the cost is simply the cost of acquiring the asset, cost of acquisition. So we said that n is the number of years of the assets, while the residual value is the value of the asset at the end of its useful life, while cost is the cost of acquisition. So whenever you are given these details, it will be very simple to now determine the percentage that will be used to calculate the depreciation rate. Let's quickly take an illustration that will drive the message home. Now, if you look at what is showing on the screen just now, you can see an illustration there. Let's use that illustration to drive the message. You say a motor vehicle cost 6,400 in 1991. It will be kept for 5 years and then sold at a residual value of 200 naira. He said you are required to use diminishing or reducing balance method to, number 1, determine the depreciation rate. Number 2, prepare the depreciation schedule. Number 3, post provision for depreciation to the necessary account. Very simple. Now, looking at this illustration, you will see that there is no percentage here. As an accountant, you are given this kind of information. How will you be able to determine the percentage that will be used to ascertain the depreciation rate for each of the useful life, each of the years of the useful life of the asset? We are going to adopt our formula. We said the formula is simply 1 minus the n root. Don't forget the n root of what? Residual value all over what? All over the cost. All right, let me correct this impression, because most times you can see this formula in the form of objective. Sometimes the examiner can write 1 minus n and then write the root like this and write residual value all over cost as an option. Some other time you can see 1 minus n root cost all over residual value. This could be option B. Some other time they can still write 1 minus n root residual value cost all over what? Residual value. Please, whenever you see options, you see this is option A, option B, option C, and option D. When you see different options like this, please don't forget the correct formula is 1 minus n root residual value all over cost. This root covers the residual value and the cost. This root is not written like 1 minus n root residual value all over cost. It's not written like this. This is something very different in mathematics. If you have n root residual value all over cost, it will give you a different figure. This is what we are working with. We are working with n minus n 1 minus the n root of residual value all over cost. There is need for students to get this clarity so that by the time you see it in examination, it will be very, very disappointing that after you have gone through this video, you have studied very hard, you come to the examination hall and then you see something like this, you become very confused. Please note that the formula is 1 minus n root of residual value all over what? The cost. So let's quickly use this formula to solve the illustration we have on the board. Now, the illustration says that the motor vehicle cost 6,400. So your cost here is equals to what? 6,400. Residual value is equals to what? 200. While your n is equals to what? How many years? 5 years. So we are going to use these figures now to enter. We are going to put this figure into this formula and see what it will give us. Now let's go. We say 1 minus the n here is 5. So you have the fifth root. It's going to be the fifth root now. Fifth root of residual value is 200. All over what? Cost is what? 6,400. Use simple mathematical formula to get this. Now, this is what we are looking for. We are looking at the percentage that will be used to determine the depreciation in each of the year. So if this 0 cancel this 0, this one will cancel this one. Now, 2 into 2 is 1. 2 into 6 is what? Into 30 into 64 is what? 32. So when 2 go into 2 is 1, and then 2 into 64 is what? 32. Now, what is going to happen is that, let's rewrite this. So you're going to have 1 minus the fifth root. The fifth root of 1 all over what? 32. Now, first of all, let's manipulate this with our mathematical set. If you divide 1 divided by 32, 1 divided by 32, you're going to have something 0.03125. So this will give us 1 minus the fifth root of 1 minus the fifth root of 0.03125. 0.03125. At this point, you are going to use your mathematical set as well to find a fifth root. Now, students find it difficult to use your mathematical set to determine root that is more than 2. Once it becomes 3, 4, 5, it becomes difficult. Now, what you're going to do is that, first of all, you are going to press 5, and then there is what we call shift on the mathematical set. When you press your shift, there is an inverted V. That inverted V has a second function of x into root. When you press it, you are going to see x root something. That x root you are seeing on your mathematical set, press 0.03125. When you do that and then you press your equal to, when you press that, you are going to have 0.5. So at the end of the day, you have 1 minus 0.5. This 0.5 is everything we have here. So 1 minus 0.5 will give you, let's do it again, 1 minus 0.5, 1 minus 0.5, it will give you what? 0.5. You have 0.5. Now this 0.5 is what you have arrived at. Meanwhile, what we are looking for is the percentage. So to convert this to 100, we are going to multiply 0.5 we are going to multiply it by 100. If you do that, you are going to have 50%. So when you multiply 0.5 by 100, you will have what? 50%. So 50% is the percentage we are going to use to now determine the depreciation rate. You see how it is. Now the formula is, you first of all use the formula. Once you have entered the formula and you have arrived at the depreciation, the percentage you are going to use, at that point, it's going to be very simple for you. Because until you arrive at the percentage, you won't be able to determine the depreciation rate. Now ask me, sir, but they didn't request the percentage to be used. They did not request. But before you can determine question 1, which says you should determine the depreciation rate, you must arrive at your what? Your percentage. So 50% is what we are going to use. So now, let's quickly use 50% to now find out our depreciation rate. The cost of the asset, or just write motor vehicle, cost of motor vehicle is how much? Is 6,400. Now, for year one, your depreciation for year one is going to be the 50% that we have calculated times 6,400. 50% times 6,400 is simply 50 over 100 times what? 6,400. This will cancel this will cancel this. We'll be left with 50 times 64. So 50 times 64, it will give you 3,200. So you have 3,200. This 3,200 is what you are going to, it's your depreciation for year one. Now, to get the net book value after you have arrived at your depreciation, subtract this from this. If you subtract this from this, you are going to have 3,200. This 3,200 is the net book value after year one. After what? Year one. This is your net book value after year one. Then for your year two, your depreciation is going to be 50% times 3,200. Now, by simple mathematics, 50% of this is just to divide this by 2. So even if you don't follow the normal calculation, 3,200 divided by 2, it will give you 1,600. So 1,600, when you subtract 1,600 from here, you'll be left with what? 1,600. This will be your net book value after what? Year 2. And then you come for year 3, your depreciation also is that same 50% you have arrived at times what? 1,600. 1,600, like I said before, anything that is expected to, anything that 50% is expected to be charged on is simply that thing divided by 2. That's just a simple formula. That thing divided by what? 2. So we are dividing this by 2. When you divide 1,600 by 2, you have 800. Now let's subtract 800 from 16, you have 800. This 800 now is a value, your net book value after year what? Year 3. And then you come down, your year 4 is depreciation, 50% times what? 800. This will give you 400. If you subtract this from here, you have 400. And this will be your net book value after year what? After your year 4. And then your year 5, depreciation is 50% times 400. It will give you what? 200. When you subtract this from here, you have 200. And this will be your net book value after year 5. Now, let's look at the question and let's look at the illustration on the board. Can you see what the question says? That it said it will be kept for 5 years and then sold at a residual value of 200. Whenever you are using this diminishing balance method, the value you will arrive at the end of the period should be equal to what is giving you in the question. Now you see this is the 200 that it is assumed to be the value of the asset after 5 years, and that's what is given in the question. So anybody that looked at this calculation will see that from the beginning the cost of the asset was 6,400. Now the first depreciation is 3,200. When you subtract the first one from here, you have 3,002, and then you have to calculate the 50% on the net book value of the asset after year 1. That is why we are having 3,002 here. And then your net book value of of the asset after year 2 is when you have subtracted the depreciation for year 2 from this net book value of after year 1. When this is subtracted from here, you get this. Then you calculate 50% on this to get this, and this will be subtracted from this to get this. And you calculate 50% on this to get this, subtract this from this to get this, and then you calculate 50% on this 400 again to get this, subtract this from this to get your residual value, your net book value after the 50 years. So what you've been able to do now, you've been able to determine the depreciation rate for each of the years. So for year 1, the depreciation is what? For year 1, the depreciation is what? 3,200. For year 2, depreciation is what? 1,600. For year 3, depreciation is what? 800. For year 4, depreciation is what? 400. For year 5, depreciation is what? 200. You can see now, I have said from the beginning that larger amount of depreciation is charged at the beginning and lesser amount at the end. You can see that 3,200 is far higher than 200 here, because at this point, the asset has actually lost a whole lot of value. So it will be very, very unprofessional to assert or to account or to charge the same amount of depreciation on the asset at this level. Let's quickly go to question 2. They said, prepare the depreciation schedule. Prepare the depreciation what? Schedule. All right, we will not touch this side because we are going to use these values to prepare the depreciation schedule. The depreciation schedule is simply the tabular representation of the various depreciation. The tabular representation of the various depreciation. All right, so let's go. The depreciation schedule. Depreciation schedule. It has just 5 columns. 1, 2, 3, 4. 1, 2, 3, 4, 5. The first one is the years. The years. The second one is the cost of asset. The third one is the depreciation. The fourth one is what we call accumulated depreciation. And the last one is the net book value. Is the net book value. Now, why I don't want to remove this is just for you to know what we are doing, to know where we are getting the figures from. So now, the asset will last for 5 years. So since it's going to last for 5 years, you're going to have 5 different columns. 1, 2, 3, 4, 5. Going to give you 5 different columns. So you have year 1, year 2, year 3, year 4, and then year 5. This the years of the asset. Now, for the cost of the asset, cost of asset. Now, for the cost of asset, they are just 6,400, 3,200, 1,200, 800, 400. So you come here, the beginning, the cost is 6,400. The second one is 3,200. 3,200. The third one is 1,600. The fourth one is 800. And the fifth one is what? 400. And then for depreciation, I have mentioned that for the year 1, the depreciation for year 1 is what? 3,200. 3,200. And then for year 2 is 1,600. Year 3 is what? 800. Year 4 is 400, and year 5 is what? 200. Now, for accumulated depreciation, I have said accumulation. When you talk of accumulation, accumulation has to do with when things are piling up, when there is, an addition of a previous event to a current event. We can call it accumulated event. When what is done yesterday is added to what is done today, both of them form an accumulation. So when we talk about accumulated depreciation, we are talking about the depreciation of the previous year and the depreciation of the current year. So looking at it on this table, so the first column here, you have 32, you have 3,200. This 3,200 is the depreciation for year 1. Then for depreciation of year 2 is going to be the depreciation of year 1 and the depreciation of year 2. So you are going to add 3,200 to 1,600, which is going to give you 4,000 what? 800. And then for depreciation, for accumulated depreciation for the third year, you are going to add 800 plus 4,800, which will give you 5,000 what? 600. And then for the accumulated depreciation for the fourth year, you're going to add 400 to 5,600 to get 6,000. To get 6,000. And then to get the accumulated depreciation for the fifth year, add 200 to 6,000 to give you what? 6,200. Now, the net book value is just the value of the asset at the end of each year. Like we have calculated here, you can see beside the table, you see that I pointed out that the net book value of the asset at the end of each year is simply the depreciation minus the what? The cost of the asset. And it has been stated here, the net book value after the first year is 3,002. The net book value after the second year is 16. The net book value after the third year is 800. Net book value after the fourth year is 400. And net book value after the fifth year is what? 200. Now we are going to apply that to the table. Looking at this table, you cannot subtract this. You can't subtract accumulated depreciation from the cost of the asset. Rather, you are going to subtract the depreciation of the asset from the cost of the asset. So when you subtract 3,200 from 6,400, you have 3,200. Now, when you subtract 1,600 from 3,200, you have 1,600. When you subtract 800 from 1,600, you have 800. When you subtract 400 from 800, you have 400. And when you subtract 200 from 400, you have 200. Like, let me remind us again that at this point, you can see that the net book value at the end of the fifth year is the same thing with what is given to us in the question. The question says that the net book value is what? 200. So once you prepare your depreciation schedule and the net book value you have at the end of the lifespan of the asset is the same thing with the value you have in the question, you don't need anybody to tell you that you have gotten your full mark. No examiner will remove anything from your mark. So that's that. Now the next question is they say you should post provision for depreciation to the necessary account. Post provision of depreciation to the what? Necessary account. I think at this point we are still going to leave our board. We are still going to leave our board. Let's leave our board. So we will be able to use the value here. But let's do away with the table so that we'll have space to be able to prepare the various accounts that are involved. Now, basically, we have 4 different accounts that are necessary for the posting of the depreciation. Number 1, the asset account. The account for the particular asset you are charging the depreciation on. Number 2, the profit or loss account. The profit or loss account is an account that is prepared to ascertain the profits realized within the period. And then the third one is what we call the provision for depreciation account, where you have all the various depreciation you have calculated. And the last one is the balance sheet, what we call statement of financial position, where you will give a picture of what the effect of the depreciation on the asset. So very quickly, we are going to achieve that on the whiteboard. First of all, let's look at the asset. The name of the asset is called what? Motor vehicle. So you have motor vehicle account. When you have your motor vehicle account like this, here is the credit side and here is the debit side. Since we are operating with Nigerian currency, you don't forget your Naira sign. Now, at this point, you ask yourself, what is the cost of the asset? The cost of the asset is what? 6,500. You come here and you write cash, 6,400. And then you can write your balance carried down, 6,400, and that closes what? The account. You have completed that. Now, the corresponding entry of this will be in the cash book. As you can see now, you see that the cash here is debited to the motor vehicle account. The corresponding credit entry will enter the cash book to complete the double entry principle that says that for every debit entry, there must be a corresponding credit entry and vice versa. You don't forget the double entry principle because it is the foundation, the bedrock of accounting practices. There is no posting, no transactions that can be successful in accounting without the application of the double entry principle. Now, having done that, the next one is what I call the trading profit or loss account. Now, the trading profit or loss account, the depreciation is always accounted for in the profit or loss account. So you come down and write your profit or loss account. Your profit or loss account at this point, it will look like this, and then this side is the credit side, while this side is the debit side. So let's assume they said this thing, they bought this in 1991. So you just come here, write your 1991. The depreciation is how much? For 1991, depreciation is 3,200. You put your line. For 1992, depreciation is how much? 1,600. You put two line. For 1993, depreciation is how much? 800. You put your two line, and then for 1994, depreciation is how much? 400. You close it, and then for 1995, depreciation is 200. 1, 2, 3, 4, 5. This is how to post it to the profit or loss account. At this point, you have entered the whole depreciation on the debit side of the profit or loss account. Remember, if it is trading profit or loss account, the trading account ends where the profit or loss account begins. Let me say that again. The trading account ends where the profit or loss account begins. The profit or loss account is the part of that trading profit or loss account where the expenses incurred within the period is accounted for. And depreciation is one of such expenses that need to be accounted for. Why we are having it just here like this is because it's a sketch. It's not a full transaction. If it is a full transaction, you will have other expenses like salary and wages, you have electricity, you have rent, you have bad debt, and so on and so forth. So that's how to prepare the profit or loss account. Let's look at the other two before we quickly round up the lesson. Now, the other two now remaining is called the provision for depreciation account. Provision for depreciation account is prepared like this. Write provision for depreciation account. Provision for depreciation account. You see come down, and then everything is prepared in a team format. Now, I don't want to remove these values because we want to use this value to prepare our account. Now, the first thing you are going to remember is that this is provision for depreciation. You see, when we talk about depreciation, sometimes this thing sounds so abstract. Like, are they actually real? In reality, is there anything like this, or we are just appreciating the theoretical framework of what we are talking about here? No, in reality, there is what we call provision for depreciation. In business or in an organization, this thing that we call provision is not as if this money is actually spent. There is an account that is open where this amount of money is actually posted to. So when you are preparing an account like this, you have T method. It's an account that is open in a bank. Like the bank have the account, this account like this with them. So when at the end of each year, this money is sent to the account, they don't touch that money. That money is there. So that at the end of the asset, that money can be combined to buy a new asset, just to replace the previous asset. So what we are doing on the board, we want to give students a picture of what is obtainable in the business organization. Just have this in your head that in the business environment, there's an account that is open that is called the provision for depreciation account. And then all this money that you see here that we are writing, we write it in form of figure. They are money that you see or you find in the account. Now, let's go. The first thing that will be here is the year 1991 and then 1991. The 1991 here, your profit or loss account. The amount that we are going to have here is going to be the depreciation for 1991. So the depreciation for 1991 here is what? 3,200. 3,200. And then for 1991 here, you have your balance carried down is what? 3,200. And that will be that for 1991. And then for 1992 is going to be this value. You are going to have balance brought down, the balance of the previous years, which is 3,200, plus the depreciation of the current year, which is 1,600. And then when you add them, you have 4,800. And then you come here, you write your 1992, your balance carried down is what? 4,800. And then you have your 4,800 here. You have completed the one for 1992. And then you do that 1993, you have your balance brought down, which is 4,800. And then you add the one for that current year, which will be being in the account of profit or loss as 800. And then when you add it, you have 5,600. Then you come here, your 1993, your balance carried down is this value, 5,600. And then you close the account, 5,600. And then for 1994, the same thing. Your balance carried down, balance brought down is 5,600 plus what? For profit or loss account. You have 400. When you add, going to have 6,000. And then your 1994, your balance brought down is 6,000. And then you close it. And you close. Then the last but not the least is your 1995. You have your balance brought down, which is the 6,000, plus your profit or loss, the depreciation for that year, which is 200. And then when you add, you have 6,200. And then you come here, 1995, you have balance carried down, you have 6,200. And then when you close up the account, 6,200. Now you can see now, if you go down, you see that the value that will remain here is 200. That value is the value at the end of the asset. This is how to prepare the provision for depreciation. You can see that anybody that accesses this account, if you have this account with the bank, at the end of the day, the bank will tell you that, sir, this is the amount of money we have as the depreciation of your asset. So with this 6,200, if the asset is no longer in use, you can use that 6,200 to now go and buy another asset. And then the very last account that you are going to look at just now is what we call the statement of financial position, what you will call the balance sheets. And then the balance sheet is also a very important statement to prepare. Mind you, a balance sheet is not an account, but a statement. It is a statement that shows the asset and the liabilities of the business. Now, let's look at the balance sheet. The balance sheet. Now, this balance sheet will also take the form of a T method. We have other methods that can be used to prepare it. Now, you just come here, write your 2 naira sign, and then you write the year, 1991. What is the asset? Motor vehicle. What is the cost? The cost is 6,400. What is the depreciation? Depreciation is what? 3,200. When you subtract this, you have 3,200. And then for 1992, motor vehicle, we still have the cost, The cost is what? 6,400. What is the depreciation? The depreciation here is the accumulated depreciation. That's what you are going to use to subtract this. So you are going to subtract this value, this 3,200 plus the depreciation here, which is 1,600, is going to give you 4,800. So you are going to subtract 4,800 from this value. So you have your depreciation is going to be what? 4,800. 4,800 at this point. 6,400. 6,400 minus 4,800. It will give you what? 1,600. So you have 1,600. Let's remove this one so it will be clear enough. This is 3,200. This is 1,600. And then for 1993, you have 6,400 again. You have the motor vehicle again. You have your motor 1993. You have your motor vehicle 6,400. You have your depreciation. Your depreciation at this point is 4,800 plus 800. So you have 4,800, 4,800 plus 800. It will give you 5,600. So you are going to have 5,600 at this point. 5,600. When you subtract 6,400 minus 5,600, you're going to have 800. So you have 800 here. And then for 1994, your motor vehicle is still 6,400, and then your depreciation is 5,600 plus 400. That's 6,000. So you have 6,000 here. So you have 6,000 minus this, you're going to have 400. And then for 1995, you're going to have your motor vehicle is going to be what? 6,000 plus 200. This is 6,400. Your depreciation is 6,200. So your value now is going to be 200. So you can now see, at this point, you can see that year one is the cost minus 3,200. You have 3,200. The cost also minus 4,800. You have this. The cost minus 5,600. You have 800. The cost minus 6,000. Minus 6,000, you have 400. And then the cost minus 6,200, you have 2,000. You are going to ask me, how come the cost doesn't change? When you are reducing balance method, you are always going to use your accumulated depreciation to affect or to charge on the cost. But if it is sum of the year digit method, you are going to use the netbook value. All right, so far, this is how to prepare the various accounts that you will confront in the reducing balance method of depreciation. Let's quickly go to our exam guide if we will be able to see one or two questions that can further explain what we have done so far. Once you click on your exam guide, you see what is already showing on the screen. You see account, another subject. Click on account, and then for the year, you can choose any year of interest. And then once you do that, the topics also you want to really consider you can also choose that. Once you are done with that, click on get started, and the various questions that you are looking for will just pop up. Now we are going to look at a question that relates to what we are doing right now. A question that has to do with reducing balance method, so that we can further explain what we have done so far. Okay, let's look at this. So I say a firm bought letting machine for 4,600 on 1st January 2015. The last span was estimated to be 20 years, while scrap at the end of the period was at 1,600. It was to be depreciated by what? Fixed installment method. This one is very simple. They say the depreciation per annum is what? Very simple. What you just need to do is to divide the value of the asset by the useful life of the asset. The asset is 45,600, and then they say the asset will last for 20 years. So what you just need to do is to divide the value of the asset, just divide the value of the asset by the useful life. What is the value of the asset? 45,600 divided by 20. So if you do this, this will cancel this. You'll be left with 4560 divided by 2. 4560 divided by 2. You will have 2280. So the answer there is 2280. That's option B. 2280, option B. Let's take the very last question. All right. What is going to happen is, what you are going to do, they say a fixed asset was bought for 60,000 on 1st January 1997. Depreciation was charged at 10% on cost. It was sold for this. So what you are going to do now, calculate the depreciation. Calculate the depreciation. When you calculate 10% on 60,000, 10% on 60,000 is what? 10% on 60,000. You are going to calculate 10%. 10% times 10%. This cancel here, this will cancel here. What you are left with, we are left with what? 1, 2, 3. This is 6,000. So they said that a fixed asset was bought for this on 1st January 1997. Depreciation was provided at 10% on cost. It was sold for 16,000 on 30 June 2001. From 1997, 1998, 1999, 2000, 2001. That's 4 years. That's 4 years. So what is going to happen is you are going to calculate this. You are going to calculate this for 4 years. You are going to calculate this for 4 years. The cost of the asset. Cost of the asset. Cost of the asset is what? 60,000. Now for year one, you are going to have 10% depreciation. 10%, 60,000. 10% times 60,000. This will give you 6,000. This will give you what? If you subtract this from here, you have 54,000. And then for year 2, depreciation is still 10% times 54,000. This one will give you 5,400. This one will give you 5,400. And then when you subtract 5,400, if you subtract 5,400 from 54,000, you will have 48,600. 48,600. This is the net book value. This is the net book value. And then for year 3, you have depreciation of 48,000. 10% times 48,600. 48,600. That will give you 4,860. 4,860. So you have 4,860 minus 4,8600. You have 43. You have 4,3740. This is your net book value. And then for year 4, depreciation is still 10% times 4,3740. 4,3740. And it's going to give you 4,374. That will be the depreciation. When you subtract this, you are going to have, 4,3740 minus 4,374. You have 3,9,366. All right, this is a net book value after year 4. Let's calculate now. They said the thing was bought in 1997. So 1998, 1999, 2000, and 2001. That's 4 years. That's year 4 now. So we are going to calculate. So at the end of year 4, the value we have there is 39,366. But they said that the asset was sold for what? 16,000. So since the asset was sold for 16,000, that means there was a profit, because that means there was a loss, not a profit. There was a loss, because the value was actually, the value of this asset after 3 years supposed to be 39,366, but they sold it at the rate of what? 16,000 to 3. So let's subtract 16,000 from this value minus 16,000, 1, 2, 3. So you'll be left with 23,003 something. That's supposed to be a loss. So the loss there is meant to be, when you subtract 16,000 from this, you'll be left with 39,366 minus 16,000. You have 23,366. You have 23,366. Supposed to be a loss. So the thing was actually, the asset was disposed at a loss. So by extension, the answer is supposed to be a loss of this value. Supposed to be a loss of 23,366. But it's not among these options. Now, what I advise students to do is, whenever you are doing an objective like this, and you have gone through the process and you are very sure that you have not made a mistake, there are times when the examiner can decide to give you a questions that may not go, that the options may not be there, to see your level of study. Don't be panic. Once you know what you are doing, you just move on. You skip a particular question that does not have that answer as far as your procedures and the method you have adopted is correct. All right, so far that is how much we can take for our lesson on diminishing balance method for today. I recommend that you take time to go through previous videos so you will have a foundation on the topic so far.